For a long time, supply chains have been built around minimizing cost. That is essentially sourcing from wherever production is cheapest with a heavy reliance on just-in-time logistics. I think this is now going to shift quite quickly, especially with recent, conflict in the Middle East and the geopolitical outcomes from that. It's now going to shift very quickly towards balancing the geopolitical outcomes as well.
Welcome to The Greener Way. I'm your host, Michelle Baltazar from Financial Standard Sustainability. Critical minerals sit at the center of the clean energy and AI boom. Today, we will unpack the latest research, the supercycle of critical minerals debate, the looming shortages, and the supply chain constraints. So what should investors rethink next? We're joined by Vinnay Cchoda, who is the Manager of Responsible Investments at BetaShares. Vinnay, thank you for joining us.
Thanks, Michelle. Great to be here.
You've recently written a paper on critical minerals. So let's start with that. Tell us the key takeaways.
I think the easiest way to frame this at a high level is that critical minerals have moved from being a relatively niche part of the commodities market to sitting right at the center of how the global economy is being reshaped. What we are essentially seeing is really the convergence of three structural forces. The first one is electrification. As we decarbonize energy systems and electrify transport, we are moving towards technologies that are significantly more material intensive. Batteries, renewables, grid infrastructure, all of that requires large volumes of minerals like copper, lithium, nickel. The second one, which is more recent, is AI. And there's a tendency to think of AI as purely digital. It's an app on your phone, or it's like a website on your laptop. But it's actually underpinned by something very physical. The whole AI revolution is underpinned by data centers. Yes, these are the same data centers that were until recently powering the transition to cloud computing just until a few years ago. And well, now these same data centers are powering the AI revolution. So data centers require a huge amount of energy and infrastructure, which then drives the demand for electricity, transmission, and storage. Again, all of which are mineral intensive and require large amounts of critical minerals. And then the last one, or the third one, is geopolitics. For a long time, supply chains across the world were optimized for cost and efficiency. What we are essentially seeing now is a shift towards resilience and security of supply. We're seeing governments and corporates thinking much more carefully about where materials and products come from and how exposed they are to disruption. When you put all these three forces together, you get a situation where demand is rising across multiple fronts at the same time. And concurrently, we are seeing suppliers not always able to respond quickly, and I'll dial into that a bit more. So we are essentially talking about these minerals. They're backed by capital-intensive projects with long lead times, and in many cases, processing capacity is highly concentrated, which adds another layer of complexity. So the key takeaway is that critical minerals are becoming both an enabler of these structural trends and increasingly potential constraint on them as well.
I know. I'd hate to say the cliche, but it's almost like a perfect storm of this massive demand and then the underpinning critical minerals, if you like, catching up to that. And then now we're talking about geopolitics in the mix. But were there any surprising findings at all as you went through the data? I'm aware that you've been talking about this critical minerals arms race since 2023. So clearly, this is not something new.
Yes, absolutely. It's a good question. So while we were doing our research, we found one particular surprising finding. And, we keep hearing about this concept of a super cycle, which is usually spoken about in the context of commodity cycles. And while we were conducting our research for this paper, one of the most interesting findings was that while the supercycle concept for these minerals is directionally right, but it's probably too simplistic of an approach from an investment perspective. And I'll dig into that a bit more for your audience. The key framing here is that the structural case is clearly very strong. You've got electrification, AI, geopolitics, industrial policy, all driving demand for the same set of minerals, and that does point to a sustained period of higher demand going forward. But what stood out is how uneven the market is actually once you go beneath the headline. And a quick example in battery metals, for example, supply has lithium, we're talking about lithium, supply has ramped up quite quickly over the past few years. That's contributed to a sharp correction in lithium prices from their 2021, 2022 peaks. And we have seen similar pressure in areas like nickel, where new supply has come online faster than expected. On the other side, we have seen some parts of the market look far more constrained. Copper is probably the best example here. It's much harder to bring on new supply, and demand is broad-based across electrification grids and now again data center infrastructure. So we have seen copper prices hit all-time highs in the last one odd year. So the surprise is that you can have a very strong long-term demand story, but very different outcomes across individual minerals depending on how quickly supply responds. And this is being reflected in prices. To me, that doesn't invalidate the supercycle idea, but it does suggest that it's likely to be more uneven stop-start kind of supercycle rather than a straight line higher. And that in turn kind of reinforces the need for, from an investment perspective, to take a more diversified approach if you want to capture the broader trend and not, go all in on one particular mineral or one particular thematic within this larger, broader thematic.
I feel like we're so used to the predictability of the long-term trends, but now you've pointed out this could be a stop-start, and you see prices collapsing in ways that they've never done before with critical minerals. So I do want to touch on the impact on investors later. One thing that you've mentioned in your white paper, which is the two massive forces of AI and clean energy. I don't want to put you on the spot right now, but are there any materials that are most likely to face shortages? What happens to demand when both AI and clean energy grow at the same time?
What happens is that demand doesn't just grow, it intensifies across the same system at the same time. The ecosystem of critical minerals was built around clean energy, and now we have this massive demand coming in from AI. So, we're essentially seeing clean energy already driving demand for lithium, nickel, cobalt, graphite, copper, and rare earths through, let's say, EV storage, wind, solar, and grids. Then we add the demand from AI on top of that. AI adds another layer as it drives demand for data centers. Those data centers are extremely energy intensive. That creates like a flow-on effect. You need more electricity, more grid capacity, and more storage. So rather than replacing demand, AI is effectively amplifying existing demand and doing so across many of the same minerals that we use for clean energy. And essentially, that's where the pressure starts to build. So essentially, copper is important for wiring and transmission. Rare earths are used in various components across the clean energy value chain and more broadly across infrastructure that we need for electrification. Then there's the hardware side of things. Semiconductors, cooling systems, connectivity chips, all of that, sit within a very complex global supply chain. So while AI is, digital, it's very physical in its footprint. The demand is growing and it's adding to already existing demand. In terms of just answering your question, where we could see supply constraints, copper probably stands out the most. The IEA has been pretty clear that copper is the main area of concern because it is essential to electrification grids and the broader industrial build-out. And supply growth looks much harder to bring on in terms of lead times. Lithium is another one to watch, I would say. Even though supply has grown very quickly and prices have declined sharply, the IEA still flags lithium as a major exception where future supply may not be fully, comfortable if demand keeps accelerating. I read a stat somewhere that one of the scenarios of the IEA essentially predicts that there could be a 40% undersupply of lithium in the next 10 to 15 years. So we could, kind of tying in what I said in terms of uneven cycles or stop-start cycles. We could see lithium again, accelerating in terms of price movements in the next 5 or 6 years. But yeah, that's essentially what it is. I wouldn't frame it as a broad-based shortage across all minerals, but rather a system where specific bottlenecks emerge as multiple drivers converge at the same time.
It's crazy. One, you know how you just kind of casually said there could be potentially a 40% undersupply of this critical mineral in the next decade or so. But that is a red flag for investors and something that they should worry about, or they should at least know, well, what do we do next? So then I noticed you've said the word supply probably 4 or 5 times in the last, couple of minutes. So let's
Yep.
talk about supply chains. Do you think that we're heading into a major structural bottleneck with the supply chain, or is the industry going to try and compensate for this, super demand and scale fast enough to meet them?
I think the short answer is that parts of the system can scale and they will scale, but not evenly and not without bottlenecks. So on the mining side, we have actually seen that supply can respond more quickly than expected in certain areas. Battery metals, again, are a really good example over the past few years. Supply of minerals like lithium and nickel has ramped up quite significantly, which has contributed to price corrections. The IEA notes that since 2020, supply growth for battery metals has been roughly twice the rate seen in the previous decade. So that tells us that given the right incentives and pricing environment, capital can flow into the sector and new supply can come online. More broadly, that's really only one part of the story. The bigger constraint in many cases sits further downstream in processing, refining, and even the broader industrial ecosystem around these materials. That's where I think the capacity is more constrained, more capital intensive, and often more difficult to replicate quickly. It's also where a lot of the geopolitical nuances of complexity sits because, as you would know, processing of these critical minerals is heavily concentrated in certain regions. So, yeah, even if you can increase raw material supply really quickly, you still need to build out the rest of the value chain to actually make these materials usable at scale.
It feels like the theme has been consistent since we started chatting, and that is the unevenness of the response. So I'm saving the best question for last, but again, going back to the impact on investors, how should companies and investors rethink their investment strategy, considering all of this, the supply chain issue, the double demand from AI and clean energy for critical minerals, and finally, as you've pointed out, a new norm in the supercycle?
Thanks, Michelle. I think the key shift is going to be going from thinking about efficiency to resilience. And, to explain that real quickly, for a long time, supply chains have been built around minimizing cost. That is essentially sourcing from wherever production is cheapest with a heavy reliance on just-in-time logistics. I think this is now going to shift quite quickly, especially with recent, conflict in the Middle East and the geopolitical outcomes from that. It's now going to shift very quickly towards balancing the geopolitical outcomes as well. So essentially, we're going to see companies and investors think more in terms of security of supply, processing exposure, geographical diversification, and how to ensure long-term access to materials, and also to ensure that these companies are operating in jurisdictions which are more politically aligned with certain blocks of nations across the world.
Vinnay, you've done such an amazing job on the white paper covering it, and I'll recommend it to our listeners. We'll share it in our show notes. Anything else you'd like to add before we wrap up?
So just stepping back real quick, AI has really shaken things up in what was otherwise a fairly niche commodity space. It's added a new layer of demand on top of the energy transition, and in doing so, it's made critical minerals, far more central to how the global economy is working than it was, say, a few years ago. And I think that that naturally leads us into the next question is and which we're starting to explore is as AI continues to scale, what are the second and third order effects on the rest of the economy? And that's probably something we're going to cover in future white papers. More on that to follow.
Vinnay, once again, thank you so much for joining us.
Thanks, Michelle. It's been great to chat. Thank you for having me.
For those of you who want to read the white paper, we will share the link in our show notes. And again, I'm your host, Michelle Baltazar. Thanks for listening to The Greener Way.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.